The structure, though, I think that we can really benefit families that are investing with us and that invested with us over many years, is that we try to mitigate as many risks as we can. In this particular deal, we've got here just a general structure. The number that I really want you to look at is that hold period, 2 to 5 years. I mean, there's a very big possibility that we could stabilize this project in 2 or 3 years and get 100% of that investor's money back, plus another $112,000. So I just want that to sink in for people, that typically when you see a multiple or it's over a 5-year hold, and we've certainly underwritten this particular model for a 5-year hold, but there is a good reasonable expectation that we could be selling this thing in year 2 and 3, and that we can get our investors' money back to invest in the next thing.
Very cool. Okay, so I just want to repeat that because it sounds so crazy. Across the industry, what I see is a lot of people can double your money every 5 years if they do a good job. What we're talking about is actually getting people their principal back and an additional 112,000, which would be a 2.12 equity multiple. And if we're talking about between 2 and 5 years, that's a very fast return. Is this actually realistic? Can people actually create that? Is there something special about this particular model that allows for that value add multifamily cannot do?
Yeah, what I would say is we've had a little bit of a head start here, right? So we've got the land already in place, we've got the loan, we've already started building. So, people that are coming in now, it's a little bit different as if they were investing, when we're in the kind of early stages of figuring out entitlements and such. So there are definitely some distinctions that I think build-to-rent, it has a superior kind of advantage to multifamily in that we can build each of these units singly and rent them up immediately, so we consistently have cash flow coming in. I think it's worth noting that we've got very low operation budgets for these properties. So, if you're in a multifamily project, you should be in that 50% range. Well, this is brand new. This is new technology. These are brand new units, very low maintenance. So typically people are managing these properties in between 29 and 32%. So I think that there's things like that really make a difference. And if you think about somebody who has the opportunity to be in their backyard, with their dog and their doggy door, and there really is huge advantages. As we go through some of the mitigants, the risk mitigants that we talked about, really want to make sure that we have a real safety net for our investors. I think that will show through.
Speaking of safety net, what do you think would have to happen in order for our investors to lose money on this?
So this is the part that I think everybody, if you're kind of, in your kitchen, you're thinking about, wow, Derek's kind of interesting to listen to, but I really want you to just stop for a second and just take a look at this slide that Ruben has, because what I just said in the previous slide was that if we execute our strategy, we can still believe pretty conservatively that we can deliver a 2.12 multiple. Okay, now that is partly because we've had some advantages and a little bit of a head start here. But I just got done saying that the average operating expense ratio for most projects in this built-to-rent space is at between 29 and 32%. So Derek says, hey, look, I just want to have a buffer just in case. So we underwrote that at 38%. Break evens at 62%. That means that we could pay our bills if we are only at 62% occupied. So 60 or so of those units that we got of that 98, 61 and a half units only need to be occupied for us to deliver on this strategy. You've seen the contingency reserve. So we'd have to blow through the contingency reserve. We'd have to blow through that extra cushion we've got on our expenses. We'd have to come all the way down to 62% on occupancy. And then here's the big one. Cap rates, and let's just say it this way, values would have to decrease in that 2 to 3 year, 4 year time span significantly for us not to be able to deliver this deal. So if cap rates were to creep up from 5.25 where they are now to 6.25, this is still a better deal than that 18% IRR, 2.12 multiple. So I like to tell people, like, look, we're going to be somewhere in between. We're not going to win on all of these, right? We'll be somewhere in between the operating expenses. We'll be somewhere in between on the cap rate. But I already knew, because we had so much room, that we could underwrite at the low end and still deliver a real nice return to the investors. So that's why I want, you can go back to your dishes now, but I really want that to sink in, because there's an opportunity for you to change your family's life here in the next 48 hours. And usually these sell out pretty quickly, but that's the reason that I'm really trying to help shake people and, look at what we can do.
Yeah, it's a big deal, right? So I know about 100 operators, probably a lot more than that, honestly. Andy, same thing. He's worked in this industry for over 20 years, and we have both been very careful and diligent about selecting the very best operators that not only do good or are good at what they do, but that are actually having the greatest impact on the communities and creating the greatest returns for our investors, for our own families, right? So we're all in this, I think a lot of us are, for generational wealth, for creating the maximum return that we can in the shortest period of time and as fast as possible and with the greatest impact. So what I would like to do is invite you to get some additional questions. We didn't put everything in here and want to bore you with all of the details, but we have all of the PPMs, the operating memorandum. All of those documents are in our Syndication Pro portal that you can find at legacyacquisitions.com.